Hello everyone, welcome to our channel Master Trader 1949X. Today we are taking a small course on basics of stock market. But before that we request you to go through the disclaimer shown in the beginning of the video. The primary goal of creating the video is to provide clear insights into the fundamentals of the stock market by presenting well-structured content that starts from the basics. To begin with, numerous individuals initiate businesses, ranging from a handful to groups of 5, 10, or even 100 people. There are many such companies established. Despite the abundance of companies, not all opt for listing on stock markets or exchanges, each conducting its business autonomously. Sometimes companies require funds to finance expansion, invest in new projects, pay off debts, or pursue other strategic goals. So companies often go public through an initial public offering, that is IPO, to raise capital by selling shares to the public. A company initiates its presence in the stock market through an IPO. A detailed video on IPO will be uploaded soon. Following an IPO, companies secure listings on stock exchanges like NSE or BSE, or sometimes on both. Participants of stock market can now apply in these IPO, and if they are allotted shares, they become part owners of the company now. The stock market is like a big store where you can buy and sell parts of companies. If you own a part, you're a shareholder. When the company does well, your part can become more valuable. Investing in the stock market is accessible to anyone through the convenience of their own device and internet connection. The Indian stock market commences its pre-market session at 9 a.m., concluding at 9:15 a.m. for order placements. The regular market session operates from 9:15 a.m. to 3:30 p.m. for standard trading, followed by after market hours from 3:40 p.m. to 4 p.m., facilitating additional order placements. Market is closed on weekends and public holidays. Commodity market hours in India are from 9 a.m. to 11:30 p.m. Both the stock market and the commodity segment remain closed on weekends and on designated public holidays. Who are market participants? Regulators, stock exchanges, companies, investors, traders, and market intermediaries all play vital roles in the functioning of the stock market. Let us discuss about each market participant. First is regulator. In simple terms, the stock market has a referee called a regulatory body. This referee watches over the game, stock market, to ensure everyone plays fair and the rules are followed by all the players, including companies and investors. The NSE, National Stock Exchange, and BSE, Bombay Stock Exchange, are two major stock exchanges in India. They are like organized marketplaces where people can buy and sell shares of companies. NSE and BSE facilitate trading, helping investors connect to trade stocks and determine their prices. Third participant of stock market are companies. Companies participate in the stock market by issuing shares, which are then traded among investors on stock exchanges. This process allows companies to raise capital by selling ownership stakes, and investors can buy or sell these shares to potentially benefit from price fluctuations or receive dividends, or companies can engage in investments as well. They might invest in other businesses, assets, or financial instruments as part of their strategic and financial activities. Investors are like long-term players, buying stocks and holding onto them, hoping they'll grow over time. Traders are more like quick decision makers, buying and selling stocks rapidly to take advantage of short-term market changes. In the framework of financial transactions, various intermediaries play crucial roles. Some of these are: first is depositories and depository participants. They enable the digital ownership of securities through dematerialization. For example, NSDL and CDSL are prominent depositories in India. Second, trading member, also known as stockbroker. A stock exchange member provides securities trading services. For example, entities such as individuals, partnerships, corporates. Third, clearing member is responsible for clearing and settling deals executed by trading members through clearing houses. It also manages the post-trade process to ensure the seamless completion of transactions. Fourth is clearing house, also known as clearing corporation. It acts as an intermediary, ensuring the accurate transfer of securities and funds. They virtually eliminate counterparty risks by guaranteeing the integrity of transactions.
Fifth is clearing bank. It establishes a link between clearing corporations and clearing members. They also maintain accounts for settling funds and meeting financial obligations.
Now we will talk about stock index. Stock indices are indicators that represent the overall performance of a group of stocks. They provide a snapshot of how the stock market or a specific sector is doing by tracking the combined value of selected stocks within that index. Example: Sensex, Nifty 50, etc. There are three different types of stock market indices or index mentioned below: benchmark index, sectoral index, and market cap based index. Nifty and Sensex are benchmark indices in the Indian stock market. Nifty tracks the top 50 stocks on the National Stock Exchange, while Sensex monitors the 30 major stocks on the Bombay Stock Exchange. They serve as key indicators for market performance and help investors assess the overall health of the stock market. Sectoral indices are stock market indices that track the performance of specific sectors within an economy. Some prominent ones are Bank Nifty for banking sector, Nifty Auto for automobile, Nifty IT for Indian IT companies. Market cap-based indices track the performance of stocks based on their market capitalization. Market cap is calculated by multiplying a company's stock price by its total number of outstanding shares. Examples include the S&P 500, which includes large-cap US stocks, and the BSE Sensex in India. The Indian stock market comprises various segments allowing investors to trade a wide range of financial instruments. Some key segments are: first, equity segment that involves buying and selling of shares or stocks, representing ownership in a company. Second is derivative segment, which includes futures and options contracts allowing investors to speculate on price movements without owning the actual assets. Third is commodity segment, which involves trading in commodities like gold, silver, crude oil, etc. through commodity exchanges such as MCX. Fourth is currency segment, which deals with trading in currency pairs, allowing investors to participate in the foreign exchange market. Fifth is mutual fund segment, which provides a platform for buying and selling units of mutual funds, allowing investors to pool their money for diversified investments.
Now we are going to learn how to start investing in a stock market. Firstly, people who want to buy or sell stocks can't do it directly on the stock market. They need to use registered stockbrokers to make those transactions for them. 2. Thanks to digital platforms, investing has become easier. You can now manage your investments online, making the whole process more convenient and accessible. So as to commence trading, one must choose a stockbroker and establish a trading account. But how to select a suitable stockbroker? The process involves selecting a suitable broker based on factors such as fees, account options, research tools, customer service, and reputation. What are the steps to open the account? Go to the chosen broker's website and locate the option to open a new account. Then, complete the online application form, providing necessary personal and financial information. Then submit Know Your Customer, that is KYC documents, including proof of identity, address, and bank details. This may involve uploading documents or mailing physical copies. The broker will then verify your application and documents. This process may take a few days. Once approved, deposit funds into your trading account using available payment methods. One should thoroughly review the terms and conditions, understanding fees, commission structures, and other important details. Establish security measures like two-factor authentication to protect your account. Once your account is funded and verified, you can start trading stocks, ETFs, or other financial instruments.
Let us throw some light on the essential steps to start trading. Having a Demat account and trading account is essential before you start to trade. On receiving the login name and password details, traders can start with trading. It is recommended to modify the default password to avoid any hacking risks. Did you know that beginners can definitely invest in stock market through mutual funds because they offer diversification, professional management, and accessibility to a wide range of assets? But what are mutual funds? A mutual fund is an investment fund that pools money from many investors to purchase securities. Mutual funds give individual investors access to diversified, professionally managed portfolios. Let us also introduce you to SIP. Systematic Investment Plan is an investment route offered by mutual funds, wherein one can invest a fixed amount in a mutual fund scheme at regular intervals. Most commonly, people use the terms traders and investors interchangeably, but both the terms have significant difference. A trader focuses on short-term profits by frequently buying and selling assets based on market trends and technical analysis. Whereas, investor takes a long-term approach, aiming to build wealth over time by purchasing assets with the expectation of appreciation or income generation. Choosing between trading and investing depends upon an individual's risk-taking ability and patience. Investing is long-term and involves lesser risk, while trading is short-term and involves high risk. Further, trading can be classified based on time duration. First is day trading, also referred to as intraday trading, entails buying and selling financial instruments within the span of a single trading day. Second is position trading, on the other hand, is a strategic approach where trading positions are maintained for an extended period, typically spanning weeks or months, with the goal of realizing profits. Third is swing trading, a trading method which aims to seize short to medium-term profits in a stock or any financial instrument within a time frame ranging from a few days to several weeks. Fourth is long-term investing, often termed position trading, involves holding onto a position for an extended duration, typically spanning months or even years. Fifth is scalping, is the briefest trading approach which entails investors utilizing high trading volumes to generate profits, prioritizing frequency over maximizing gains per trade. Sixth is momentum trading, a strategy employed by traders, focuses on exploiting anticipated patterns in short-term price fluctuations of financial assets to achieve gains. So as to enhance your investment choices and assist you in reaching your financial objectives, one should know types of investors. First is retail investors, that is, individual investors who acquire assets like stocks, bonds, securities, mutual funds, and exchange-traded funds. Their purchases typically involve intermediaries such as brokerage firms, investment advisors, investment managers, or other financial experts. Second is domestic institutional investors, refer to large-scale institutional investors that operate within the boundaries of a specific country. For example, mutual funds, insurance companies, pension funds, and banks that invest money within a country. Third is foreign institutional investors, FII or foreign portfolio investors, are institutional investors from abroad who participate in the financial markets of a specific country. Do you know that one can also categorize investors based on risk appetite? Conservative investors prioritize capital preservation over high returns. They are willing to accept lower returns in exchange for lower risk and are more likely to invest in fixed income securities such as bonds. Then comes moderate investors who seek a balance between risk and return. They are willing to accept some degree of risk in exchange for the potential for higher returns, but they also prioritize capital preservation. Last is aggressive investor who prioritize high returns over capital preservation. They are willing to take on higher levels of risk in exchange for the potential for higher returns and are more likely to invest in equities or alternative investments. Now comes the question that, how do individuals involved in the stock market assess market conditions? Fundamental analysis is a mechanism which is used to determine a stock's actual or fair market value. Fundamental analysts look for a stock which is currently trading at a price that is either higher or lower when compared to its real value. When the fair market value is greater than the market price, a stock will be considered as undervalued. A buy recommendation will be given. Another method used is technical analysis. Technical analysis is a method used in the stock market to predict future price movements based on historical data. Traders use charts to spot trends and patterns in prices. There are three types of trends: uptrend, that is, prices go up; downtrend, that is, prices go down; and sideways, that is, prices move within a range. We will now introduce some most commonly heard stock market terms. First is a stock and share. Stocks is generally used to refer to portions of ownership of multiple companies. For example, you could say that you own stock in Amazon and Microsoft. Second is share. Shares usually refers to units of ownership in a specific company. For example, you could say that you own 10 Amazon shares. Next comes market capitalization. Market capitalization, sometimes referred to as market cap, is the total value of a publicly traded company's outstanding common shares owned by stockholders. Market capitalization helps determine the size and worth of a company in the market. And what are blue chip stocks or companies? Blue chip stocks are high-quality stocks of well-established companies that have a proven track record of financial stability and consistent growth. The best blue chip stocks to buy are considered safe and reliable investments, making them a popular choice for long-term investors. Have you heard of the terms bull market and bear market? A bullish market is one in which prices are generally expected to rise. If you expect the stock prices to go up, you are bullish on the stock price. From a broader perspective, if the stock market index is going up during a particular period, it is referred to as a bull market. Opposite to this comes bear market. A bear market is a finance jargon used to describe a steep drop of 20% or greater in an asset from its most recent high, which may happen over the course of weeks or months. Going short or going long? But what do they mean? Long position means they are buying shares of a company with the expectation that the stock price will rise over time. In other words, they are betting on the stock's value to increase so they can sell it later at a profit. On the contrary, short position means selling shares of a company that the investor doesn't own. They do this by borrowing shares from a broker and selling them with the intention of buying them back at a lower price in the future. Short sellers profit if the stock price goes down because they can buy back the shares at a lower price, return them to the broker, and pocket the difference. Another commonly heard term is OHLC. Open, high, low, and close. Open is the price at which the stock opens for the day. High is the highest price at which the stock trades during the day. Low is the lowest price at which the stock trades during the day. And close is the closing price of the stock. Learning a few basic terms is important to understand the stock market. Liquidity, volatility, bid price, ask price, market order, limit order, portfolio. First is liquidity. Liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. Second is volatility. It is a rate at which the price of a security increases or decreases for a given set of returns. If the prices of a security fluctuate rapidly in a short time span, it is termed to have high volatility. If the prices of a security fluctuate slowly in a longer time span, it is termed to have low volatility. Third is bid price. The term bid refers to the highest price a buyer will pay to buy a specified number of shares of a stock at any given time. Now what is ask price? The term ask refers to the lowest price at which a seller will sell the stock. The bid price will almost always be lower than the ask or offer price. A market order is an instruction to buy or sell a security immediately at the current price. A limit order is an instruction to buy or sell only at a price specified by the investor. Market orders are best used for buying or selling large cap stocks, futures, or ETFs. A limit order is preferable if buying or selling a thinly traded or highly volatile asset. Last but not the least, portfolio. A portfolio's meaning can be defined as a collection of financial assets and investment tools that are held by an individual, a financial institution, or an investment firm. When we talk about a financial instrument, it is mostly associated with terms such as 52-week high and low, all-time high and low, upper circuit and lower circuit. The 52-week high or low is the highest and lowest price at which a security, such as a stock, has traded during the time period that equates to 1 year, that is 52 weeks. All-time high and low is the highest or lowest price level that a particular stock, index, or market has ever reached since its inception or for a specific period. An upper circuit refers to the maximum percentage increase allowed in the price of a stock or security within a single trading session. When a stock hits its upper circuit, trading in that stock is temporarily halted to prevent excessive volatility. Conversely, a lower circuit refers to the maximum percentage decrease allowed in the price of a stock or security within a single trading session. When a stock hits its lower circuit, trading in that stock is temporarily halted to prevent panic selling and further price declines. Now, once all the formalities are done, with the help of an example, we will teach you how to buy shares in the stock market. For instance, you decide to buy shares of XYZ company at ₹50. Log into your trading account with your stockbroker and place an order specifying price at which you want to buy and the quantity of shares. For you to buy, the share broker ensures you have sufficient funds in your account. The order hits the stock exchange, for where an order matching algorithm seeks a seller willing to sell the specified shares at a given price. The stock exchange matches your order with the seller, and once executed, the shares are credited to your Demat account and debited from the seller's account. After purchase, you become a part owner of the company to extent of your shareholding. Through this video, we will explain how to buy shares on Zerodha. First, the user has to enter his credentials on the app and log into his account. Then you will receive an OTP to further complete the login process. The screen you now see is where you can see the watch list. On the search tab, look for the share you want to buy. If the share of your selected company is listed in both NSE and BSE, you can select your preferred stock exchanges. Now the selected share appears in your watch list. Next, you can click on the share. For example, here we have taken Trident Company in National Stock Exchange. Click on Buy option and a pop-up screen appears. Fill the number of shares you want to buy in quantity. You can buy shares in both MIS and long term. In MIS, the shares get squared off automatically before market close, and in long term you can hold for desired period of time. If you want to buy at current market price, select market type and then swipe to buy. The shares will be bought if you have sufficient funds in your account, and it will show as completed. Now you can view your purchased shares in Position tab. Before we end this video, have a look at these charts. Here we see charts of Nifty 50 index, depicting its values over 34 years, and Nifty Bank index chart, depicting its value for 24 years. Followed by charts of two prominent ETFs, Nifty Bs and Bank Bs, for over a period of 15 years approx. Now we have charts of two prominent companies, Reliance and Infosys. Both these companies are chosen randomly for example purpose. As evident from the charts, between 1990 and 2024, the Nifty index surged nearly 80-fold, while the Bank Nifty index saw a 46-fold increase from 2000 to 2024. This substantial growth underscores the advantage long-term investors have over traders, as they are less affected by short-term market fluctuations. Similarly, Nifty ETF, Bank Nifty ETF, Reliance, and Infosys have also seen substantial growth over time. Thus, for a long-term investor with a well-chosen stock portfolio, there's less risk compared to traders or short-term investors. Long-term investors are less affected by temporary fluctuations in the stock market. Hence, with well-informed decisions and stock market discipline, a long-term investor can always gain substantial profits. With this, we come to an end of our first video. Our aim was to provide viewers with that max information about stock market. Remember to read the disclaimer at beginning of the video. More interesting and detailed videos will follow up. Don't forget to like, share and subscribe to our channel. Press the bell icon for notifications about latest videos.